Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Understanding what your partnership agreement should include. Before we begin, we need to cover just a few very important items. First, please close any other programs running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit, you must complete 2 requirements today. First, you must participate in all 3 of the polling questions throughout the presentation. Please note that GoToWebinar does monitor your participation. Next, you will receive a link to an online evaluation. I will email that to you later this afternoon. You must complete that online evaluation in order for your CPA certificate to be issued. Once those requirements are met, I will email you the certificate, and that will happen within 10 business days. There is an additional very brief survey for the webinar that pops up immediately after the session ends, so please take a moment to complete that before you close your browser. This survey is different than the link that I'll be sending you, but it's still very important to us. This will enable you to request additional information, such as a copy of the presentation, and it'll also help to ensure that we're providing you with quality information. In order for you to fully participate in the webinar, please familiarize yourself with the GoToWebinar control panel on the right-hand side of your screen. The orange arrow on the top of the control panel will help you minimize it. During the presentation, everyone is muted, but you can communicate with us by using the question box toward the end of the control panel. Just type your question in the box and click Send. Questions are important to us, and we'd like to address any of your concerns, and our presenter, Terry, will answer your questions at the end of the presentation today. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. The upcoming topic for January is tax season implications for M&A of accounting firms. For a complete list of all of our webinars, including links to register for them, you can visit the CPE courses section of transitionadvisors.com. There you will also find links to watch recorded versions of our webinars, including today's webinar. We are recording that, and that will be available online for you to view later. Also, just a note, I sent out a link just now. If you'd like to follow along with the presentations, you can click on that link to download the PDF. So with all that said, I'd like to now introduce our presenter for today's session. Terry Putney is the CEO of Transition Advisors. Thank you very much, and enjoy the webinar.
Thank you, Nikki. Welcome, everybody. Just one additional note on the recording. If you like what you hear today and you've got any peers or associates that you'd like to direct to the webinar, you can get a full copy and full recording of this webinar on our website. That'll be loaded on by the end of the day. Just a little more information about Transition Advisors for those of you that aren't familiar with us. We are a national consulting firm. We work exclusively with accounting firms on issues related to ownership transitions. So that involves, we do a lot of work with mergers and acquisitions, arranging those, helping firms that have found their own merger partners negotiate deals, actually making introductions for those that need assistance with searching for merger partners. Working with succession planning with firms and partnership agreements, including compensation plans. So the topic today, obviously, is on the issue of partner agreements. A little more in terms of the associates in our firm. Besides myself, you may be familiar with Joel Sinkin, who's the president of our company, does quite a bit of speaking nationally. Bill Carlino is the former managing editor of Accounting Today, is now, for the last 2 years, have been with us as managing director of our national consulting services. Some of our other consultants that work directly with our clients are Mark Buzinski, Russ Bess, Nancy Egan, sorry about that, Peggy Tyers, who manages our Canadian operations, Marcia Miller, Mike Farinelli, and Kay Conklin. So we're going to start off with a polling question so all of us get some idea of who's on the line. I'll turn it back to Nikki for just a second so we can answer this polling question.
Our first polling question is, how many equity owners does your firm have? You can see the multiple choice options there, so just take a minute and select the one that is applicable to you. We'll leave the poll question open for about 30 seconds, and just keep in mind that you do need to answer all 3 of the polls in order to receive your CPE credit. looks like nearly everyone has completed it, so we'll go ahead and close the poll. And you can see there the results. 85% of the folks on the phone today have between 1 and 3, and then 4 to 6 is the next most popular. With that, I'll turn it back to you.
Okay, thank you. You know, there's probably a specific reason why you're interested in this topic and what we're going to talk about today. You know, some of the typical issues that we deal with firms regarding their owner agreements are a lot of firms don't even have an agreement. Those that do may not be comfortable with how they deal with compensation amongst the owners within their agreement. A big issue nowadays as firms deal with succession planning is how to bring in new partners into the firm. Some are not comfortable. Many firms are not comfortable with their buyout arrangements. Some partners may think they're too high. Some partners may think they're too low. Some partners may feel like, well, there's no way we can afford these payments. That's typically a sentiment amongst younger partners when they start thinking about all the people that are going to retire ahead of them. How are we ever going to pay them off? Some feel like their agreement didn't work very well last time they used it for either terminating a partner or retiring a partner or bringing someone else in. Hopefully we'll be able to address all the issues that you're interested in. Needless to say, in the course of an hour, we won't be able to get too in-depth into any of those issues. And I'd like to encourage you, if you have any questions about your owner agreement or your situation that you'd like me to address, I'd be happy to answer any emails that you have, or you can contact me otherwise. We can arrange a consultation. So feel free to send me a question, and I'd be happy to try to address your issue for you later. The specific topics that we're going to address today include, how to deal with compensation, how to deal with governance, issues specifically related to death, disability, and of course retirement, other types of termination, which primarily would be either voluntary or involuntary termination, and how to potentially, if you ever need to, unwind the partnership. The different types of compensation plans that we typically see are equal compensation, where everybody takes the same amount out, a pure formula approach, a cross-evaluation approach, approach that's based strictly on ownership or equity, and then allocations done by committees or by a leader. Let's get into more specifically what that involves. We typically see equal compensation in situations where a firm starts off from scratch. It's not unusual to see, maybe 2 or 3 young people leave a larger firm, decide to go out on their own. They've got no clients to speak of, or maybe they've brought a few clients with them, but for the most part, they're all just, eager and energetic, and everybody's out doing the same thing, looking for business, trying to grow the firm. And the feeling is that, we're all in this together. We're all working as hard as we can. We really don't have the basis for any kind of allocation of profits other than we'll just do it equally. And that generally works for a while until, at some point it becomes obvious that some of the partners are not performing at the same level as other partners. And if that goes on for too long, that we have an equal compensation arrangement and things start feeling like they're out of whack, then people become resistant, become reluctant to continue on in that system, and if it isn't fixed, of course, the firm can break up. So for a while, equal compensation works. Now, I've actually worked with firms that have been around for a long time that still use equal compensation, and oftentimes the reason why we're talking about it is because they're no longer interested in continuing that approach. Generally, the next level, or oftentimes a different version of maybe a way to start, is an equity-based system. Now, normally when we talk about an equity-based system, we use some base compensation involved. It's difficult when you have someone that owns 10% of the firm and someone that owns 40% of the firm to have a situation one person's making 4 times what the other person is. So it's rare that equity-based would be that's strictly how all dollars are allocated, unless the equity is somewhat equal. But where we find equity-based systems emerging is usually because a firm maybe has come together with existing books of business. And so, one partner brings in a $500,000 book of business, and another partner brings in a $750,000 book of business, and another brings in a $300,000 book of business, and that between those partners that feels like, well, that's a good way to assess value, assess contribution to the profit pool. So we'll just allocate it. We'll start with equity based on those books of business, and we'll start allocating compensation based on those books of business. And as long as things stay in kind of sync that way, that'll work. Now, of course, they won't stay that way. I mean, somebody's book of business is going to change, and people's roles are going to change, and all of a sudden somebody's no longer strictly based or working on client service. They're doing a lot of administrative work, and so now the equity-based system isn't making any sense. It also tends to become a problem as you start bringing in new partners, because new partners tend to come into the firm with small amounts of equity. It's not unusual to bring a brand new partner in at anywhere from 2 to 10% of ownership. I was just talking to a firm earlier today where the 3 founding partners are at 30, or were originally 33% each, brought in a new partner at 10%, so now they're 30, 30, 30, 10. And the next new partner is going to come in at 2%. So you can see where now we have some significant disparity between the ownership between those partners. And things that made sense when they were third, no longer are going to make sense now that they have a 2% partner and 3 partners that are almost at 30%. So compensation systems that are based strictly on equity have that difficulty of sometimes not reflecting the value contribution that is being made by the partners. The next iteration tends to be to go to a pure formula approach. The typical metrics that we're talking about with formulas, the most popular, of course, is book of business. How large is the book of business? The next would be billable hours. How many billable hours does a partner produce? And then the next would be new business if they feel like they can capture that as a separate component of activity, or sometimes that just gets thrown into the book of business calculation. Another metric that gets used sometimes is equity, and then of course then you have variations like how collectible the business is, how effectively you're managing work in process, and then we can start adding some intangibles in there as well, which of course requires subjective evaluation. You know, formula approach is probably the most common of what I see in smaller firms. It's something we're all comfortable with because it's a certain kind of measurement system. It's something that you feel like you know how you're. If I do this, I'm going to get that. The obvious problem with it is it can be manipulated. So one of the examples would be that I see that can be a problem is billable hours. If we put too much weight on how many billable hours a partner produces, that actually can run counter to what that partner should be doing in the firm, which would be normally delegating work in order to grow the firm, spending the time not strictly doing the work, but actually helping others do the work. Because we all know that the more people we manage, the more business we're going to be able to manage, and therefore the more the firm's going to grow and the more profitable we'll be in the end. So you've got to be careful that you're not creating a disincentive to do what's good for the firm when you use a pure formula approach. Usually when we move away from formula approach strictly, we're trying to move into more subjective evaluation. The problem many firms have is, well, who's going to do the evaluation? So it's not uncommon for a firm to use a cross-evaluation system where the partners evaluate each other. So we'll come up with a list of criteria for what we think is important, and everybody will evaluate everybody else, and we'll kind of throw together all that information into a pool and see how it comes out. That tends to work well for a while. What happens in the long run is that as people have obvious performance issues that need to be addressed, it's difficult for the other partners to call those out satisfactorily or in a clear manner. It's hard to make that, to deliver the message that needs to be delivered because we're delivering it through a cross-evaluation system and we're not really having the conversation that we need to have. But it is a good way to start introducing some other criteria into the evaluation system for generating compensation. So an approach that you might think about in this way in combination with a formula approach is, let's take the profit pool. Maybe we start off with base compensation, maybe not. Let's assume we do. Then we end up with a profit pool that might have anywhere from 20 to 40% of the total partner compensation in it that's eligible for allocation through some kind of evaluation system. Part of that compensation will be based on some measurable criteria, like the things we just talked about. And then part of that will be based on these intangible criteria that we determine based on a cross-evaluation system. And then finally, the larger firms in the country are tending to use now committee-based or leader-driven systems, where and there's also somewhat of a tendency to move towards closed compensation systems, where in a closed compensation system is one where all of the owners are not aware of what all the other owners are making. The committee's aware of it, the managing partner's aware of it. If you have multiple offices, certainly the office leader would be aware of it, but within the rank and file of the partners, there may not be complete transparency. A committee or leader-driven system obviously depends on, and especially one with a closed compensation system, depends on a tremendous amount of trust. You've got to feel like you're being treated fairly, even though you don't have all the information necessary to make that determination on your own. It can be the most flexible. It can be very effective. If you get the wrong person and there's not enough communication going on beyond just the number, here's what you're going to make, and there's nothing that accompanies it in terms of how that decision was achieved or how it could be changed, then it can be create resentment and can create problems. So assuming that you're in a system that you don't currently feel like it's working as well as you'd like, how do you decide which system's right for you, and how do you move from one system to another without too much turmoil? Well, the most important thing to remember here is that your partner compensation system probably is the #1 thing that defines the culture in your firm. It defines how your partners are going to behave and how they're going to manage the firm and how they're going to manage their activities. So if you send the message to a partner group of what's important to them based on how you're going to pay them. So if we're going to, for instance, we're in a firm, we feel like we've really got to juice the practice development because we're not growing, then we need to put more emphasis into practice development. But one of the things you need to keep in mind here is when you get out of sync with the culture you're trying to create in the partner compensation system you're using. So for instance, let's say that you're trying to move to a one-firm concept where we're all in this together. We're not thinking of our clients as being our clients. We're thinking of them as being the firm's clients. We're trying to disperse, the responsibility for client management to more than one partner. And yet if our partner compensation system is paying us based on a book of business, there's an inconsistency there between the culture we're trying to create and what we're actually going to achieve based on our partner compensation system. So it's important to look at your system, see how that's going to define partner behavior, and make sure that's the kind of firm that you want to have. As you move from one system to another, in order to correct imbalances that and that's probably why you're doing it, is to correct imbalances. I think it's important, if you can, to avoid too much downside too fast for any of the partners, because that's where you're going to run into problems. Ideally, you're in a situation where we can deal with how we're going to allocate upside differently so that over time we achieve the goal we're trying to create. So if we've got partners that we feel like they're overpaid, hopefully through attrition and through growth, we can keep them from having to take too much of a hit, while the other partners who need to be paid more get more of what the additional dollars that are available. But if you're in a situation that demands dramatic change, you just have to do it. But hopefully you're not going to create too much risk for anybody in your group. With that, we'll move to a second polling question. Nikki, I'll turn it back to you.
Okay, our second polling question, does your firm have a signed owner agreement? As you can see, the choices there are yes, but we need to modify it, yes, and we're satisfied with it, or no, we do not have a signed owner agreement. This one's pretty straightforward. We'll leave it open for another 15, 20 seconds here to give everyone a chance to record their answer. And again, just keep in mind that you do need to answer all 3 polling questions in order to receive your CPE credit today. Okay, we'll go ahead and close that poll, and I've shared the results there on the screen. Looks like nearly half do not have a signed owner agreement, and then we're pretty split between the 2 yes options there, Terry.
Okay, good. So if you don't have an agreement, obviously we have a lot to talk about. And if you do and you want to modify it, that's something we obviously could help you with. as we look at the different kinds of partners in the firm that you might define within your firm, most firms have just one kind of partner. It's an equity partner. And if you're in a firm that has, anywhere from 2 to, say, 5 or 6 partners, it's likely that that's what you have, is just equity partners. And you may have significant differences in the amount of equity that's owned by each partner, but you probably don't have different levels. But as you become larger, or as you start admitting partners that have significant differences in the way they perform and the value that they create and the way they join the firm, you start seeing that we need to define different levels of partner. Usually it's only the very largest firms that have what are called senior partners and junior partners. The difference is normally identified for purposes of identifying differences in compensation and in how much capital might be contributed by a particular partner or maintained by a partner in the firm, so that the senior partners are required to contribute more capital and are going to make more money than your junior partners. But normally there's not going to be a difference between those two in the kind of buyout or retirement plans that they're going to be eligible for. The one thing that we do see a trend with nationally is the use of income partners. It used to be that income partner was a place where you parked somebody where you just thought, well, you know what, they're never really going to be able to perform at the level that the rest of us are, but we still want them to be called a partner because we don't want them to leave, or because they need to have that kind of title in order to function in the role we've assigned to them. But what we're seeing nowadays is the income partner status being used as a training ground for future equity partners. So we've got somebody that we're ready to make a commitment to, but we're not 100% certain they can handle it. We'd like to see that they can perform at the level of an equity partner in the firm. We know that we'd be best able to see that if we gave them the title of partner. So as far as the outside world's concerned, and even internally, they're considered a partner, but they haven't signed on to the partnership agreement. They may have a separate income partner agreement, and we might leave them in that status for 2 or 3 years while we see if they can really handle it. Another use of a different kind of partner would be in terms of mergers and acquisitions, particularly acquisitions. So we bring in somebody that's, say, in a succession mode. They maybe are going to be working with us for, say, 3 to 5 years as a partner, but we're really buying them out. That's the purpose of the whole acquisition. And we want them to be held out as a partner so they can continue to manage their client base, but they're not going to sign on to our partnership agreement. We probably have a separate contract for them, and that would be a person that would legally be considered of counsel or in an income partner, or not an income partner, but a contract partner role, or maybe a principal if you're more comfortable using that term. In dealing with governance, most firms use a consensus decision-making system. It's very rare that you see a firm that routinely votes on things, where we're voting our equity shares or we're voting on some kind of arrangement where we're holding up our hands and saying, okay, I vote for this and I don't. If you're doing that a lot, there's obviously a lot of conflict in your firm. The fact that you have a lot of 3-to-2 votes probably indicates that you're having trouble managing the firm. So most firms are going to deal with things on a consensus basis. But it still is really important to have the decision-making process for a formal voting process defined in your owner agreement. Because what tends to happen is then when we come to big issues, and we're discussing big issues like admitting a new partner or terminating a partner or changing the ownership agreement or doing a merger or acquisition, people will go back to the partnership agreement and say, okay, worst comes to worst, if we can't agree, how's the vote going to be handled? So it's important to have that formal process in place. Obviously, some votes shouldn't require anything more than a majority type of voting. For instance, day-to-day activities like hiring a senior manager or entering into a lease or acquiring a significant capital asset or some other significant expense. If you're not in a firm that is comfortable giving that responsibility to your managing partner, then a simple majority vote may be okay. The supermajority vote should be used for the very most important issues, like admission of a new partner, termination of a partner. Certainly, merger or acquisition can either be a supermajority vote or a unanimous vote. But, supermajority votes will typically be defined as anywhere from 67% of the voting interest to as high as 90% of the voting interest. Oftentimes we'll see where we have maybe a founding partner group that might make up 75% of the owner interest. So we want to define the supermajority vote as at least 75%, meaning that those three partners, or maybe even 80%, where those three partners have to agree on that issue, and then either not have to have any of the minority partners or at least one other minority partner agree with them. That's oftentimes how supermajorities are established. You know, I think there's too many agreements, in my opinion, that require unanimous voting. And where this becomes a problem, if you've got a partnership where you have 25% owners, or even say a 40, a 30, and 2/15s, requiring unanimous voting may not be a problem. But where you run into a problem is when you start having people that have very small amounts of voting interest. Go back to the example I used earlier, the 30-30-10-2. I know that adds to 102, but whatever the math works out to. That 2% ownership person is going to have as much weight in that vote as the 30% owner. And so what you've created is now a situation where you've given way too much power to someone that you had no intention of giving that much power to when you admitted them as a 2% owner. So be really careful on use of unanimous voting if you are going to have an equity ownership where you're going to have people with very small levels of ownership or equity in the firm. That'll take us to our final polling question. I'll turn it back to Nikki.
Okay, for our final polling question today, you'll see the question there on the screen. What percentage of your owner group will be retiring from full-time duties in the next 5 years? You've got the different options there. Is it none, 20% or less, more than 20% but less than a third, between a third and a half, or 50% or more? So we'll leave this one open just for another 15 seconds or so. Go ahead and select the answer that applies to you. And it looks like nearly everyone has voted, so we'll go ahead and close the poll. You can see the results there on the screen. And I'll go ahead and turn it back to Terry.
Could you name those results? I didn't see those.
Oh, sure, yeah, sorry, Terry. 51% indicated that none would be retiring. The next most popular at 24% was half or more, the largest percentage. And then after that, between 1/3 and 1/2 at 11%.
So we've got all or nothing. There are a lot of people
it.
leaving or not in at all. For those of you that don't have any of all, you're lucky, because that's not, it tends not to be the trend. Studies are showing us that as many as 65% of partners in accounting firms now are 10 years or less from retiring. So there's obviously a huge demographic issue going on in our profession. Okay, now we'll get into some guts of what a lot of people want to talk about is retirement issues. First I'd like to talk about what is retirement. Is it a benefit, or is it a means of creating liquidity for your ownership interest? If you work for, Deloitte, or you work for even a firm like, say, Clifton Larson Allen, or one of the largest, national McGladrey, you might look at retirement benefit as a benefit. This is, I work for a big company, I get a retirement plan, I'm a key employee, so I should get something more than the normal rank and file, but it's more of a retirement benefit. If you work in a firm, if you're a partner in a firm that's got, very few partners, 3 or 4 partners, you probably look at your retirement benefit not as a benefit, but as a means of monetizing the investment that you've made in the firm, the value you've created in the firm. You look at it more as an owner selling something. So it's important to understand that probably for most of the people on this call, we're not talking about a retirement benefit. We're talking about how to dispose of your interest in probably the largest asset, certainly largest business asset that you own in most cases. So the first issue we're going to deal with here is mandatory retirement age, which is a very hot topic, a very contentious topic right now in the profession amongst firms. Should your agreement even have one, and if so, what should it be? My belief is that if you're interested in creating a long-term viable firm that's going to extend beyond you, an important aspect of that is having a mandatory retirement age in your agreement. Now you're going to say to yourself, no one should be able to tell me when I should quit working, and you're right. You have that right to do that. Consequences of not having that mandatory retirement age, though, that you really don't have a plan for when you're going to leave, and no one else has a plan for when you're going to leave. More importantly, you don't have a plan for when your partners are going to leave. So as you sit here and think about, when do I need to bring in new owners? How do I stage this? How do I plan for this? You're really shooting in the dark because you're just waiting for someone to come along and say, okay, I just did my last tax return, now I'm ready to retire. So not having a mandatory retirement age makes it very difficult to have a long-term succession plan. If you do have a mandatory retirement age, it needs to be reasonable. Most of the time, obviously, the biggest default age is still age 60. We do see firms pushing those back to 67, 68. I think you get beyond 68, and you're starting to really not have a mandatory retirement age. I've seen them as late as 75, which is really saying we really don't have one. But I think that if you want to have a good, solid plan for succession in your firm long term, it's important to have a reasonable mandatory retirement age, and I'd recommend between 65 and 67 really for that age. Vesting. Most of the founding partners in the firm would consider themselves vested in their retirement benefit or retirement plan almost from the day that they entered the firm, because I helped build this firm. Why would I ever not be vested in what I built? Where this becomes important, of course, is with new partners, bringing new partners into the firm. And the two types of vesting that you want to consider are tenure, which is how long you've been a partner in the firm. In some cases, how long you've been with the firm, but usually it's how long you've been a partner in the firm, and age. So if you're in a position where you're now trying to build a succession team for your firm, you're now looking at spending a lot of time developing younger people to become future owners in the firm and admitting them as owners in the firm. Your incentive to do that, of course, is that they're going to carry out the business plan that you have in mind for succession, which means they're going to be around to buy you out, you and your partners out. So it's appropriate to set up a vesting schedule that would basically say, look, we're going to bring you in, but we're going to count on you being here in the long run. And, we see vesting schedules running anywhere from 10 to 20 years in terms of tenure, and usually age 55 minimum, oftentimes age 60 minimum, before any kind of retirement benefits are appropriate. So it would be appropriate, for instance, to maybe have a schedule of either 10 to 15 years, and at that point in time, a partner might become 50% vested in a benefit. In an age of 55 or 60, and a partner might become 50% vested at that time, with increasing vesting over the ensuing 5 to 10 years of tenure or 5 to 10 years of age achievement. That's a good way to make sure you're locking in your younger people into the succession team. It's also important if you're using certain kinds of retirement benefits, like for instance a compensation-based plan, where you might have a plan that pays, and we're going to get into this more in a minute, pays 3 times compensation over 10 years, for instance. Well, the day you admit a partner into the firm, and let's say they're making $175,000, if you're using a 3 times multiple, you're looking at a $525,000 benefit immediately. Well, chances are they haven't earned or paid for that benefit, and so using a vesting schedule will obviously keep them from achieving or taking out that benefit before they've really earned it, which they really earn over time. Dealing with partners that want to stay on after retirement, and how should that impact their compensation? Well, one of the things we're trying to avoid here, of course, is partners retiring in place, which means basically staying on forever, and that's where mandatory retirement ages help as well as keeping somebody from just hanging on and continuing to milk the firm for as much as they can while they're really not contributing like they used to. But it's helpful in dealing with the transition, because we're finding that people more and more are not wanting to quit working altogether at age 65 like they used to. Age 65 isn't what it used to be. And so giving that person an opportunity to stay with the firm, beyond the point that they're retired. Retired means, in my mind, when you start the buyout, not when you quit working necessarily. So it's very common nowadays to allow partners to stay on, maybe pay them based on the billable time that they create. We might use anywhere from 33 to 40% of their billable hours, billable dollars, or billable and collectible dollars as compensation. If we're asking them to do anything that is significant in the way of administrative duties, then we might pay them something extra for that. But allowing them to stay on, giving them a place to work, it helps a lot with them making the decision to turn over the reins and start accepting the buyout of their ownership interests. It needs to be a mutual agreement. I see a lot of firms that use an annual vote to continue the relationship so that they have the opportunity to say, really, this isn't working anymore. But, it's very common to allow some kind of post-retirement benefit. How you go about valuing your retirement interests is probably going to fall in one of these four categories: the book of business method, the equity method, the compensation method, and some hybrid of that. The book of business method pays where we identify individual books of business within the firm that the partners are responsible for managing, and we pay them based on that book of business. So if I've got a $750,000 book, my retirement buyout is going to be based on my $750,000 book. The equity method, of course, uses some kind of equity allocation. So if I own 30% equity in the firm, then we would achieve some kind of a hypothetical value for the overall firm. Let's say we use 1 times revenues, and I would be paid based on 30% of 1 times revenues of the entire firm's book of business. Compensation-based system, and I've already given you that example, would be somewhere where we would take our, say, the highest 3 of the last 5 years compensation, and we might pay a multiple of that and pay that over time. So a common method would be 3 times the average annual compensation paid over 10 years. And when that method actually was introduced many, many years ago, it was really a proxy for 1 times revenues, because remember the old third, where a third of the revenues are partner compensation. Well, a third times 3 is 1, so we've got, in essence, the same valuation, just allocated differently. And then the hybrid method might be something like a unit type system where we determine 1 unit per dollar of volume, and then we allocate those units to the partners, and that's going to be different than potentially than their equity ownership. The PCPS did in their 2012 succession survey. By the way, if you haven't got a copy of that and you're a member of the PCPS, I highly recommend you get one. Another survey that I highly recommend is the Rosenberg MAP survey, which has a tremendous amount of information in it regarding succession issues. That one's not free, because you can get that from Mark Rosenberg. But in the 2012 PCPS survey, we found that 37% of the firms that responded to the survey, and there were roughly 600 that did, used a multiple of equity system. So that's generally still the most popular approach. 16% still use a managed book of business, and I think that probably is going to be the smaller the firm, the more likely you're going to use that approach. 22% use a multiple of compensation, and 25% use something else. The larger the firm, the more likely you are to use a compensation-based system. I actually think there's a lot of advantages to compensation-based systems, because the problem with an equity system is we tend not to deal with changes in equity over time. So we start off with somebody owning, 40% of the equity, and that made sense when there were 3 of us in the firm, and that person had the largest book of business. And then all of a sudden we've got 8 partners in the firm, and this person's extraordinary amount of ownership doesn't reflect really the value that they should be allocated within that firm, and we didn't have any way of ever changing that equity ownership. Compensation, on the other hand, tends to be a lot more dynamic, tends to reflect more currently what's going on in terms of value contributions. And so if we use a compensation-based system, then we're automatically adjusting, along with the compensation, we're adjusting the retirement benefits. So I think that there's a big advantage of compensation-based systems over equity systems. In looking at the system, the terms that you should be using and the kind of system you should be using, we recommend taking an approach that we call a backwards valuation. A backwards valuation is designed to reward your retiring partners for all their years of sweat equity, for building up the value of the firm, being fairly paid for that, but not expecting the people that are left are going to make that payment to either borrow or take back the step back in compensation. So basically what we're saying here is that the best approach to devising the terms and the valuation of your retirement buyout is to make sure that the agreement is self-funding. If it isn't self-funding, it tends to create concern that, gee, why would I want to be part of this? I mean, if imagine this, a client comes to you and says, I'm going to buy this business, I'm going to lose money for the next 5 years, what do you think? And you're going to say, wow, it sounds like a great idea to me, I think you should do it. Probably not. Well, if you're asking your partners to do the same thing, which is, here, buy me out, and for the next 5 years you're going to make less money than you were making before, compelling thing, a very compelling argument. Reason to have to meet that, to have to end up with that result. The way to make sure that your plan is self-funding is this approach. The capital that you have to use for buying out a partner is that partner's foregone compensation. So we're talking about, compensation, benefits, the whole bit. So say, for instance, and we'll go through an example of that in a second. What we're going to do with the capital is we're going to pay off the partner, we're going to replace the partner, and we're going to leave some upside for the remaining partners in the firm so that they feel like they have an incentive to take on the obligation and the extra work that's required. So let's take an example. Partner's making $300,000 of comp and benefits. We decide that their replacement resources are $120,000. Now, the way I usually reach that conclusion is by looking at their billable hours. So if they're generating 1,200 billable hours at $250 an hour, that's $300,000. Usually we can hire somebody off the street for about 40% of that. If so in this example, we have $180,000 left over for the upside and for the payment terms. So let's take it through a specific example. Say the firm volume's at $1.9 million. We're using an equity-based system, and this partner owns 45% and is making $275,000. They've got a $175,000 capital account, and we decide that we're going to pay them out over 5 years on the retirement, which would be, 45% of $1.9 million is $855,000 divided by 5 is $175,000. And then we're going to pay the cost of the replacement resources are $125,000. And in this example, we're going to pay the capital account all at one time when the partner retires. So our year one cash flow in this example is, well, we've got $275,000 of compensation to work with. $125,000 is the replacement cost. That leaves us $150,000 of capital left over. That $150,000 the first year is going to be used. We're going to take $175,000 to pay off the capital account because the capital doesn't go away. The clients didn't go away. The capital is mostly made up of receivables and WIP. The receivables and WIP are probably going to stay intact. So that whatever we pay for the capital is going to have to come out of cash flow. So the $175,000 already puts us in the hole. On top of that, we're going to pay $171,000 of retirement. So the first year, it's going to cost the firm $146,000. And there's only two ways to pay for that. One is borrow the money. The other is the other partners make less money. And in years 2 through 5, in this example, we're going to have $21,000 of negative cash flow while we're paying off the retirement. This is not a self-funding plan. The alternative plan would be pay the capital over 5 years, pay the retirement over 10 years, creating a win-win situation. So now going through the same analysis, we've still got the same $150,000 of capital. We're paying $35,000 a year for 5 years on the capital account. In some cases, we might pay interest on that. If I'm going to pay interest on any deferred payments, it would normally be on the capital account. Might pay a small interest rate of, say, 3% or something. And then 85.5 is the 10-year retirement benefit. So we've created now, in this example, $29,005 of positive cash flow in the first 5 years, and then $64.5 in the next 5 years. So we can go to our younger partners with confidence and say, look, this plan is self-funding. You're going to be able to afford it. And it's going to make a lot more sense. In looking at internal valuation benchmarks, again, going back to the PCPS survey, which is where I got this information, less than 10% of firms nowadays are using more than 100% as the valuation metric for if they're using an equity-based system and applying that to the revenues of the firm. Keep in mind that we usually don't pay interest on deferred payments, especially on the retirement benefits. If you do pay interest, and say you pay 6%, you pay it over 10 years, you've just increased the cost of that by almost 30%. So normally we're not talking about 100% plus interest. The interest is normally included in the payments. It's implicit or imputed in the payments. About 40% still use 1 times revenues, and almost 30% use between 75 and 100, with the rest actually using less than 75. The trend is definitely down nationally. Most of the national firms that use something similar to a revenue-based system for valuing the firm are somewhere between 65 and 80%. For firms that are using a compensation-based system, about 40% are using 3 times, 15% use 2.5, between 15 and 20 use 2 times. Very few firms use more than 3 times, whereas it used to be that I saw many firms with old agreements using anywhere from 3.5 to 4 times. I see very few agreements like that nowadays. In looking at the terms of the agreement, the things we need to take into consideration are payout periods. The period that we usually see, oops, didn't mean to go back that quick, will run anywhere from 8 to 12 years. There is a trend to go longer. Part of that is driven by a desire to use a more aggressive tax structure in partnerships. If we use a 15-year payout, then we can use potentially an asset acquisition for the payout, create capital gain treatment for the recipient, and not create any negative cash flow because of tax consequences for the firm. When should you use a contingent-based system for determining the total buyout dollars? Ideally, you won't use a contingent system. What I find is that when firms have a system that's based on post-retirement collection, they tend not to put in place an aggressive transition plan because they don't. In some cases, the retiring partner can sense that that's happening and say, gee, I'm not sure these guys are going to keep my clients, and I'm not sure they're going to pay me. Maybe I need to go somewhere else with my book of business and find somebody I feel more confident with. And so, if you can avoid using a completely contingent system in an internal buyout, I would. On the other hand, you have to be confident that you accept that obligation. And so it's important to have a strong succession plan. And in order to do that, you also, I think, you need to have adequate notice. We usually recommend that you have at least 2 years notice of an intention to retire for the firm. That gives the firm the 2 years to execute the transition plan or decide that it isn't going to be able to execute a transition plan and go to Plan B, which might involve either a call-out sale or an upstream merger. Tax structure-wise, most agreements still treat the payments as retirement payments, ordinary income to the recipient, deductible as paid by the firm. If you're in a corporation, it's much harder to create a capital gain transaction than it is if you're in a partnership. So keep that in mind as you're deciding what entity to operate in. In a partnership, it's much easier to create a capital gain transaction for the recipient and an amortizable asset for the firm. Again, you're going to amortize it over 15 years, but if you're going to pay it over 10, 12, 15 years, you probably can afford to do that, whereas in a corporation, it's very difficult to do that unless you meet certain very strict requirements. How do we deal with new partner buy-ins? How much to charge? How much equity? Typically what I'm seeing is, some kind of, I think there's a level at which you go from, this is kind of our minimal charge to sort of join the club. We're talking about a $25,000, $50,000 investment up front, maybe tied strictly to the amount of accrual basis book value that new partner is acquiring from the firm. So if we've got $1 million of book value and we're acquiring a 5% interest, that's a $50,000 buy-in. If we use a vesting schedule, we're not worried about the fact that they haven't paid for the intangible value that's in the partnership agreement. We don't worry about that at all and let them accumulate that over time. But if you're going to charge more than, say, $25,000, $50,000, even $75,000, now you're talking about an investment. Now we're talking about, and how do we create a return on investment? Well, usually you create the return on investment through your compensation system. So if you're going to ask somebody to spend $250,000, $300,000 to become a partner in your firm, you really have to create some kind of return on that. And the only way to do that is to carve it out of the compensation of the other partners who are probably going to be reluctant to do that. So I think it's difficult to look at a partner buy-in at that level without creating some consequences that you really want to avoid. Death and disability, real quickly, I think we're talking about, in temporary disability, we're talking about maintaining compensation for a short period of time. In permanent disability, we're talking about that turning into a buyout. And the best way to manage all of these activities is through insurance, of course. Voluntary versus involuntary terminations. I think that if you're going to have an involuntary, the ability to fire a partner within your agreement, you're probably going to want to define some cause as to what's going to cause that. Now, if it doesn't mean you can't fire somebody just because you don't like them, but if you do, there should probably be some kind of fallback position, like the ability to take clients. And with that, I'm going to turn it back over to Nikki to wrap up. We're at the end of the webinar.
Terry, we did have a couple questions related to some of the examples. Do you have time to take those, or would you rather do that via email? Okay. So a couple of the questions that just came in. One of them, what if you lose, say, 30% of your business when one partner leaves? Do you see payout plans that adjust based on the business retained over the payout period?
Well, again, if you have to look at why you lost the 30%. If you in fact lost it because the partner didn't give you notice that they were going to leave, and you didn't have time to create a transition plan, then it's clearly appropriate to adjust that partner's compensation. If you're in a situation where you've got, for instance, a major client that makes up 30% of the firm's business or 30% of a partner's book of business, it may be appropriate to have a contingency with respect to the retirement buyout associated with that specific client. If, on the other hand, you lost the 30% of the business because the firm just did a poor job of managing the transition after the partner went through an appropriate transition plan and everything looked like it was in sync when he left, I don't know whether it's really appropriate to adjust in that case. Again, it really depends on how confident you are in your ability to create a succession plan, a transition plan for partners. And if you can't get yourself confident that you can do that because of the nature of your business, because of the nature of a particular partner's business, then you need to have a contingency. But you've got to make that decision when you draft your agreement, and then you've got to have a plan in place that's consistent with whatever decision you made in your agreement.
There was another question specific to one of your examples that had the cash flow analysis, and it says, what about the expense to pay for the work that the retiring partner used to do? If it can be replaced, say, for $100,000, isn't the cash flow negative by about $70,000?
Well, that was the replacement resources. So the work the partner, you go back to the example, and I don't know if I can get back there quick enough here, but in this example, this 125, let me go back even further where we were. In this example, this partner's was, let's say, generating $300,000 of billable time. Somebody's going to have to do that work, and you're probably going to have to hire additional staff to do it. And typically, the cost of a $300,000 of billable time is going to be somewhere around, $120,000 or about 40%. I came up with this 125 cost of replacement resources. I think that's been captured in this analysis. You're not going to go out and hire another $275,000 partner to replace a $275,000 partner. Otherwise, you don't have anything to work with. And it's not even the way you'd do it anyway. But you do need to account for at least the productive. Now, you may decide, a particular person you're dealing with, that the cost is more, or maybe you've got so much capacity or that you don't think you have to have as much. But normally we're talking about somewhere around 35% of the productive capacity of the partner that's retiring.
One more question, Terry. I know we're getting close to time, but what type, if any, of non-compete covenants do you see for partners, both current and?
The two types of non-competes that you need to consider are what's considered a professional non-compete, which is saying you can't practice as a CPA for a specific period of time in a specific area. And the other kind is client-specific non-competes, which says you can't take clients, provide services to the clients of the firm for a specific period of time. Professional non-competes, and this also depends on what state you're in. If you're in California or Georgia, for instance, forget it. On professional non-competes, you're not going to get one that's enforceable. But most states you can have a reasonable, as long as it's a reasonable amount of time, say 2 or 3 years, and you've got a reasonable geographic region, say anywhere from 25 to say 75 miles from any office that the firm operates, then you can say, if we're going to enter into this agreement to buy you out, you're not going to practice as a CPA in that area for that period of time. And it's important, I think, to consider doing that, because otherwise you're sending a mixed message to the clients. They're telling the clients the partner used to work on, he's no longer in business, we're doing the work now, and they say, well, wait a minute, he's down the street operating at this other firm. Why can't I go there? And regardless of what you and he have decided and agreed to in the agreement, the client's going to feel like they got shortchanged, which will hurt client retention. The client-specific non-compete is absolutely critical, and I think it's important to cover the buyout period. So if you have a 10-year buyout, you should have a 10-year agreement that says you can't provide services to the clients of the firm, at least the ones that were there when the partner retired, for that 10-year period. Because you don't want to find yourself in a position where you're paying a partner for value, and then he's taking that value back away from you, and I've seen that happen. I've known CPAs that have actually retired 3 different times from 3 different firms with the same client base. So I hopefully you don't have partners like that, but I think you should cover yourself with respect to client-specific non-competes for the payout period, at least, if not longer.
Okay.
Any other, Nikki?
We do just one more that we have time for. It says, regarding equity versus compensation, we've moved from equal to somewhat of a formula over 2 years. Should this change equity ownership, or is that a different topic?
It depends on what you're using equity for. If you're equity for anything substantial like retirement benefits or like a component of your compensation, then I think you need to be looking at equity on a constant basis and just fairly representing the value. Is it fairly, are we getting the right result from our compensation and buyout obligations? A lot of firms don't use equity for hardly anything. If you're in a compensation-based buyout arrangement, or if you're in a system where equity is not a component of your company, really is it? So it just depends on what you're using it for and what the result is in your particular situation. But if you've got a situation where someone owns a disproportionate amount of equity, and it's substantially different than the others, and it's going to really mean some dollars, it's a potential disaster that needs to be addressed, and you probably need to figure out how to reallocate it.
Okay, great. Thanks, Terry. We did have a couple other questions. I'll make sure that those get to Terry. You saw Terry's contact information on that last slide. You're more than welcome to follow up with him directly, or you can email me. My email address is in all of the reminders that you've received from GoToWebinar, so you can just reply to those if you have some follow-up questions. You'll also get an email from me later this afternoon, which will include a link to the online evaluation that you need to complete in order to get your CPE credit. If you want a copy of the slides, or if you're looking for additional information or specific articles from our website, you'll have an opportunity to indicate that in the brief survey that pops up before you close your browser. So take a minute to complete that. And again, we appreciate you attending today's webinar, and feel free to get in touch with either Terry or myself if you have any follow-up questions.
Nikki, any additional questions that were asked that I didn't get to, we will answer those in this afternoon's follow-up email.
Great, and that email will go out. It'll also have a link to the recorded version of the webinar. As Terry mentioned, you can forward that on to your colleagues, or you can review it again if you enjoyed today's session.
Thank you.
All right, thanks, Terry.